We have a great afternoon planned for you to send you all off into the ship finance summer, starting off with our dry bulk panel. So if we could have our panelists and moderator take the stage, we will turn it over to them. There's stairs right on the side, or you could just be very athletic and jump right up. Climent Molins will be our moderator, who's head of shipping research at Value Investors Edge. Climent, thank you.
Well, good afternoon, everyone, and thank you to the Marine Money team for the opportunity to moderate this excellent panel. Here we have Peter, CFO of Genco Shipping, Christos, Co-CFO at Dry Bulk, Vincent, the Chief Trading Officer at Navios, and Stavros, CFO at Seanergy. So, well, let's get right into it. Over the past few months, we've seen a couple of M&A deals go forward. Bell Ships went private earlier this year. And right now, well, we have the CMBT taking over Golden Ocean's fleet. Are you guys looking into M&A as a way to bolster your fleet? And if so, what kind of vessels are you especially focused on? And secondly, to what extent do you expect environmental regulations to have an effect on how small operators think about their willingness to sell?
Great, yeah, I'll take that one. So yeah, when we look at the M&A landscape, particularly over the last 12 months, the investability and the investor pool of pure play dry bulk shipping companies has contracted significantly with the Eagle Star Bulk as well as Bell Ships and obviously the upcoming Golden Ocean transaction. So the pool of investable shipping companies has shrunk significantly in terms of pure plays. And we think that's a really good opportunity for companies like us who are the high governance, pure play vehicles out there with a decent sized market cap. Obviously, we want to grow, and one of the ways to do that is utilizing the shares as a currency, but also continuing to have flexibility within the balance sheet. But yeah, we look at it as certainly a good opportunity, and we certainly like the larger ships. I think the demand catalysts are fairly clear, demand and supply there, which I'm sure we'll discuss a little bit later. But yeah, I think growth and accretive growth it certainly makes a lot of sense at these levels.
Christos?
Thank you for having us. We have historically acquired at Dry Bulk more than 100 vessels by using our shares as currency. And we're definitely not stopping here, so we're always looking for fleets to acquire using our shares, mostly issued at net asset value. The last transaction that we did involved mostly Ultramaxes and Supramaxes. Through vessel sales that we have been doing in the last 2 years, we have been essentially refocusing our fleet mix from being 60% middle and smaller sized and 40% by value on Cape-size vessels, more towards 50-50 on Cape-size and Newcastlemaxes, as well as the smaller Supramaxes, Ultramaxes, Panamaxes, Kamsarmaxes vessels. So we actually look right now for opportunities to further balance this ratio. As Peter said, we do like the fundamentals of the larger vessels. Although, having said that, those have also lost, the values of those vessels hasn't been impacted or has been reduced the least compared to other vessels. So we'll be always opportunistic in sort of the fleets that we look at. So yeah, right now we're always evaluating M&A opportunities, mostly focused on the larger vessels. And then taking the second part of your question, I believe that more stringent environmental regulations are definitely going to act as a catalyst for further M&A activity, because the higher the barriers to ship management, effectively the more the sophistication, and hence bigger companies should do better. Just as an example, we have 8 people in our organization looking at vessels performance monitoring day in, day out. And what they do is they study data that are coming from sensors on board our vessels. And they're basically looking on how to improve the consumption and hence efficiency, whether of the voyage or of the vessel overall. We then have one vice president looking at environmental regulations as well as decarbonization strategy. We then have a strategic planning department that is looking into new fuels and is basically signing new deals right and left on R&D in order to sort of help us have a competitive advantage when it comes to new fuels as well as new regulations. We have 150 vessels, and therefore we split the G&A expenses amongst a large number of vessels. We are able to do that, a smaller owner is not. I would like to think that this would hopefully have a competitive advantage in sort of further consolidation activity in the future, because at the end of the day, it also helps our S&P strategy, our chartering strategy. So I think environmental regulations are going to be playing a more important role in our decision-making going forward.
Thank you. Vincent?
Thank you here. First of all, you were referring to the CMB deal. We do understand the industrial logic of the CMB deal. I mean, obviously, we need to see the result of the merger in time. That will come out. At Navios, we believe that in the diversifications and economic of scale, in flexibility, stability, all these things we strongly believe in. Then, to reply on your question about mergers and acquisitions, I mean, we're entering into a period of scale, compliance, and access to capital, which is going to make a difference between the companies in our field. I mean, I do think, indeed, that the environmental regulations will play a strong role here. It's not only a technical hurdle for people, but it's also a cost driver. So I think the smaller companies, indeed, will have problems or, let's say, struggle to retrofit or to renew their fleet. I think that will accelerate, basically, the MIA, basically, in the next year. I think it's more a necessity than a choice.
Makes sense. Stavros?
Thank you. Good afternoon also from my side. Seanergy is a pure-play Cape-size company, so we have been always targeting larger ships. This will not change in the near future, at least. We are looking to grow more. We're looking to renew the fleet. Whether it's going to be on a sale, on a vessel-by-vessel basis, or whether we will be targeting, smaller fleets to do so, that's a decision, a debate that it's ongoing within the company. The fact that all dry bulk companies trade at a discounted valuation can hinder M&A activity, especially when it concerns a private owner or privately owned ships. But it's more easy to do so between two public companies because everyone is trading at discount. So, you have to solve for the relative valuation between the two companies rather than, absolute values do not really play a huge role there. So we will continue to target Capes. We will continue to look at way to allocate capital in order to ensure that we generate strong cash flows and strong returns on our capital. Now, concerning the environmental regulations and whether smaller owners will be more willing to sell the fleets, I think that in some cases the efficient scale in shipping is a bit overestimated. It's more a matter of the age of the fleet and how proactively owners have invested in the recent years in making the ships more efficient rather than being big or being small. We are a 21-vessel company, but we do have our own department that's looking after the environmental performance of the ships, and they're doing actually a very good job. We have been investing heavily in all the ships that were acquired over the last years to make them more efficient, and we see that they continue to be very competitive in the market despite, I wouldn't say the vintage age, but despite being sort of mid-aged.
Makes sense. Thank you. Now, let's shift gears a bit. The USTR, when it initially came out, had the potential to become a big deal for the overall dry bulk industry, although per the most recent wording, the impact should be more limited. Despite this change in the outlook, has this affected your appetite for Chinese-built vessels?
Well, USTR was certainly a big topic, particularly in February for dry bulk companies as it developed in the latest proposal in April. From our perspective, we are essentially exempt. Ships entering to the US in ballast essentially checks the box on our capes, and obviously the under 80,000 deadweight ton exemption checks the box on the minor bulk. So we don't really expect anything in terms of Genco's fleet specifically. So that's a big win on the dry bulk side. And also the agriculture export side, because that was a real concern when you add tariffs as well as potential port fees on top of it. It makes US agriculture exports much less competitive versus Brazilian, Argentine, et cetera. In terms of Chinese-built ships, it's hard to get away from Chinese-built ships. Half the fleet, dry bulk in particular, is Chinese-built. Genco owns Chinese-built. I think we go across the line that many owners own those types of vessels, and we'll continue to own them. I mean, when you think about making capital allocation decisions and investment decisions in a 25-year asset, you have to think longer term than just maybe the current administration or even the next 3-4 years. We have a 12-year-old fleet, and that 12-year-old fleet on average has seen 4 different administrations over its life to date. So things can change, and they change not only in the administration, but also by the day or the month. So it's hard to make capital allocation decisions that way.
I would echo Peter, and he has covered most of the aspects of the equation. Yes, we were worried, but the fact that vessels ballasting to the US and vessels below 80,000 deadweight basically cover more than 90% of the vessels and cargoes that are coming out of the US being exempted from USTR. Therefore, we're monitoring closely the situation, but for the time being, we're not worried. 2/3 of the fleet in dry bulk is Chinese-made. I think that's difficult to replace, especially as Korean shipyards have focused on other segments. So you have essentially right now China and Japan building vessels, with Japan being maybe 20 or less % of the fleet that is being built. So remains to be seen, but for the time being, it looks okay.
Thank you for the color, gentlemen. Now, Vincent, as the Chief Trading Officer, I'm going to shift gears into the demand side.
Okay.
What are you seeing on that front? And especially, what impact do you foresee should the Ukraine war come to an end?
Well, on the demand side, yes, at a certain moment, obviously, Ukraine war will come to an end, and I think that's a positive for dry bulk. I mean, obviously, there's a lot of grain trades was before the war out of Ukraine. There still is, but the volumes are much less. Obviously, the situation is dangerous, high insurance, and unsafe. If the war would end, obviously those volumes would come back, and that would be positive for the Panamaxes and the Supra. That's the first thing on the grain. Secondly, there's also an iron ore flow, basically, which used to be quite sufficient, important, let's say, before the war. When the war started, obviously, that also almost stopped. When that comes back, basically, that's mainly iron ore going to China, and that's mainly in Capesize. So I think those two are positive on the dry bulk, basically, out of Ukraine. I mean, but talking about the demand side, I think what I think is the most promising for the next years is West Africa. I mean, there's a lot of, commodities and projects being developed in West Africa and is going on. The main trades, what I can see is bauxite and iron ore. I mean, on the bauxites, if you go back 5 years, the Capesize trade was almost not existing. Now, basically, it's very an exponential growth. I mean, if you look this year, until now, is about 40% more exports out of Guinea mainly to China. In absolute terms, that's like 22 million tons. This is obviously all long ton miles and mainly Capesize. The second thing is iron ore. I mean, there's a couple of projects on stream, basically, and the biggest one, which is everywhere around, is Simandu. Simandu basically will start in Q4 this year. It's been controlled by 3 Chinese partners and Rio Tinto. I mean, it's a huge project. I mean, they will, from zero, ramp up to about 120 million tons of iron ore in the next 3 years. And it's already predicted like 30 million in 26. To put it in perspective, 30 million is like the equivalent use of 44 capes for the whole year. So this is really huge. This is, again, long ton miles and mainly cape size. To me, West Africa in a whole is basically the most promising on the dry bulk side in the years to come.
Makes sense.
If I may jump in here, the important thing also with Simandu is the high iron content of the local product. I mean, you have pressure on the price of iron ore, and this is expected to push non-efficient, non-cost-efficient mines out of the market, and then moving, I mean, to source product, either to source product that has been locally mined in China or is being sourced from Australia, from West Africa. That's very important because you will see also the replace factor there, and you will see ton-mile demand growing. And further to the Simandu, you have also Vale in Brazil, improving efficiency and expanding S11D, which adds to further long-haul iron ore tons. So, I mean, it's all looking very positive on the demand side.
If I may add, Simandu is 50% owned by Chinese. Therefore, the long ton miles that we all strive and wish for in shipping are basically guaranteed, given that China is definitely going to utilize this source. But I fully agree. I mean, Simandu and West Africa together, with the increased projected production from Vale, is essentially half of the existing Brazilian export capacity. So that's huge for our industry.
Thank you. Peter, we've touched upon most of the commodities carried by capes, but we're missing coal. What are your expectations on that front?
Look, in terms of the coal trade, this year we've obviously seen a decline in the overall Chinese coal trade. It's basically doubled over the last 2 years. In 2022, China was importing about 300 million tons of coal. Last year was about 540 million tons. That sort of growth, almost doubling year over year over that 2-year period, is essentially unsustainable. So seeing a pullback within coal is not surprising. We've seen a little bit less out of Indonesia. Those are more shorter haul ton mile trades, more Supermax, Panamax. Seeing those longer haul tons out of Colombia is a little bit more impactful for the larger ships. But look, when you look at the overall coal trade and you look at China as the largest importer, they're producing 4 billion tons of coal domestically. Imports are a very small percentage of what their overall coal mix is. But when you kind of break down commodities, certainly there's the bull case in the iron ore and the bauxite, and coal is about 20% overall of total dry bulk trade. If you just basically assume a flat coal trade over the next few years and growth in the other commodities, it's still pretty impactful, particularly given the ton miles.
Thank you. We've covered the supply side pretty well. Now let's shift into the demand side pretty well. Sorry about that. Now let's shift to supply. What do you gentlemen think about the order book first? And secondly, we've been hearing that dry bulk has a low order book for years now. Do you expect upcoming environmental regulations to make the true upsurge come?
Sure. Actually, there's a chart that I like that our research department has produced lately. It basically shows delivery by deadweight of dry bulk throughout the last 20 plus years. So what you see essentially is that 12% of the existing fleet is 20 years or above. And then you have an astonishing 44% of vessels that have been built between 2006 to 2013. And those are hungry ladies. Those are vessels that have been produced at the peak of the market in Chinese shipyards, sometimes shipyards that did not exist before. And at the time, we had about 100 million deadweight being delivered each year, which is an astonishing number. I mean, right now you have 30 to 40 million deadweight that's being delivered by dry bulk shipyards across the globe. So essentially, what we have in dry bulk is 56% of the current fleet being either built in Chinese shipyards and having a very high energy consumption, or being 20 years and above. Right now, the order book is 10%. I think at some point, demand catches up with supply, and then should the 20-year plus the vessels that were delivered between 2006 and 2013 sort of start to be scrapped, at some point, we will need to build many more vessels if we are to essentially sustain the same level of fleet that we have nowadays. I'm not sure people have realized that. It's impossible for us to have deliveries of 100 million deadweight like we had in 2009, 10, 11, 12. And therefore, at some point, there's going to be a squeeze.
Thank you. Vincent?
Yes, I would like to add to that, basically. I mean, yes, the order book is very low, and I think the shipyards are pretty full with all kinds of ships, containers, tankers, LNG, and a little bit of dry until 27, 28. So that's one point. The other point is with the USTR, with the, let's say, the tariffs, there is a kind of uncertainty. So I think there is hesitation from people or for owners to invest, basically. So those two, I think, will, as such, restrict in the next couple of years the supply of ships. That's one thing. For the rest, I do agree. I mean, we have seen a couple of presentations here yesterday. We were pointing about the CII, about the carbon pricing, basically, the increasing penalties. I mean, that's going to kick in. I think the one, basically, which are less compliant, they will first be phased out. And I think at a certain point, we're going to see a kind of reduction of the supply coming.
Makes sense. And now let's shift into a question that each of you will have to answer individually. What are you doing right now to create shareholder value? And then that's going to be the analyst in me speaking. What's your stance on share repurchases versus buying assets at market pricing, considering the discount your shares are trading at?
Look, capital allocation is obviously the most important thing that any sort of capital-intensive business like shipping will deal with, and it's top of mind all the time. What Genco did during this cycle, in the beginning of the cycle in 2021, we used the cash flows to really transform the balance sheet. We delevered significantly, bringing our net loan to value to 6%. We paid down about 80% of our debt. Then the focus shifted more toward dividends and returning capital to shareholders during a very strong period of time in the cycle, and we've paid 23 consecutive quarterly dividends to shareholders over the last 5+ years, which is the longest stretch among our peer group. So we're very proud of that. More recently, and getting to your second question, we've layered in a share repurchase program, an opportunistic one at that. What we did notice, particularly in April and May, was that there was a significant disconnect between the fundamentals of the business that we've all been talking about here today, as well versus the valuation. And that disconnect breeds opportunity. And we do think there is opportunity out within the shares among many of the names that are trading at discounts to valuations that are certainly different than the current share price. So, when we have a Cape market at 30K today, the Cape market was actually lower a year ago, but yet the share prices were much higher. So I think there's a lack of conviction in the equity markets. There's a lack of conviction in the forward curve versus spot. There's significant backwardation. But when you take the holistic approach to capital allocation, it's dividends, it's growth, fleet renewal, and it all can be done holistically when you have a strong balance sheet like Genco has established over the last few years.
Thank you. Christos?
Clement, this has been our favorite question this week. Because we just announced that we've, essentially in the last month, we have bought back $32 million of our shares. And if you see what we have done essentially the last 2 years, we have sold 39 vessels at quite good prices. And we have focused on selling the least energy efficient vessels. We have generated proceeds of $470 million, and we've used these $470 million to acquire 25 million of our shares. So we have been extremely active on the share buyback side. because we cannot understand how is it possible that there is such a big disconnect between being able to sell vessels at net asset value, because we're continuously testing this, and then buying back our shares at a significant discount to this net asset value, therefore instantly capturing this arbitrage and effectively offering this to our shareholders. So this strategy has been in focus for the last, especially couple of months, but also years. At the same time, we've been deleveraging, not to the same extent as Genco, but our net debt is around 20% today. And at the same time, we've also given back to our shareholders $1.3 billion dollars of dividends that has been generated through essentially operating cash flow.
You guys have been busy. Thank you. Vincent?
Okay. Obviously, at Navios, I'm the chief trading officer. So my day-to-day job is basically to create value for the company by fixing ships. I mean, we obviously do that by doing a spread between period and spot when it makes sense. That's the first thing. And obviously, the second thing is we obviously monitoring to buy and sell ships in the right time of the cycle. I mean, obviously, the capital allocation is the responsibility of our finance teams. We have a dividend policy and we have a buyback program which provide for us enhanced shareholders' returns.
Thank you. And Stavros?
Yeah, for us, I mean, creating value, we see that in the context of our overall business strategy, which is centered around buying ships that can generate strong cash flows and therefore strong returns on capital, keeping leverage under control, not as much as Christos or Peter are doing, but at around 50% so that we can ensure that the balance sheet remains strong throughout the cycle. And then also staying loyal to our dividend distribution policy, which concerns a large part of our free cash flow. Now, I mean, dividends and buybacks are a good way to deliver this value to shareholders, but it's not the same as creating value. And out of the two, historically, we have done both. I mean, we are a 140 million market cap company today. We have returned around 90 million to the shareholders in the last 3 years. 50% of that was through dividends and 50% was through security buybacks. Right now, we see the market being a bit more receptive when it comes to the valuation of the stock on the dividend front. Buybacks, they're adding, I would say, an additional layer of doubt to investors, so an additional layer of uncertainty, because you're basically betting that you will trade higher on the next upcycle or in the next market rally because of a lower share count, whereas dividends is much more tangible. Now, if we see the market being a bit more receptive on valuation, we might shift towards buyback again, but now the focus is on dividends.
Thank you. We're running a bit tight on time, but does anyone have any questions? Okay, no. So thank you, gentlemen, for this Dry Bulk panel.
Thank you for having us.
Thank you.